Welcome to The Commercial Edge, the podcast where business, property, and legal insight come together. I'm your host, Elizabeth Rebolledo, lawyer, founder of Ardor Legal, and your guide to navigating the commercial world with clarity and confidence. Let's get into it. Hello, Mark. How are you today?
Good, Liz. How are you going?
Really great. Look, thank you so much for joining us on The Commercial Edge today. I'm really happy that you're here. Ever since the budget dropped, people have been a little bit anxious, so we're going to cover a lot of that today. But before we get into it, tell the listeners who you are, what you do, and what you love the most about what you do.
My name's Mark Tannous from Purple Patch Advisory. We have an accounting and advisory practice located in Cannon Hill in Brisbane. We basically help business owners, property investors, people with self-managed super funds, help them to reach their goals, obviously with the advisory side, the tax side, to get to where they want to be.
Mm-hmm. And what do you love most about doing that?
Well, it's really about, helping the business owners and property investors, make the confident decisions to know what they're deciding on, what the big picture is. So at Purple Patch, we don't just do the tax advisory. We really do like to do help the clients to create the wealth and support them through all the stages of their journey.
Fantastic. I bet you've been really helpful recently since the budget dropped. Now, you said the property owners and business owners are within the scope of your client base. Since the budget did come down, what has the mood been amongst your clients?
It's pretty overwhelming. There's a lot of media out there at the moment, and it's not really clear what is happening with the budget or what even happened after post-budget. So it's sort of moving away from the headlines that you're seeing in the papers, in the press, and really getting more to the nitty-gritty, which, to be honest, has been a bit tricky because they keep changing their ideas as well. So.
It doesn't help for planning purposes if they give you one plan and then change it as well.
Yeah.
Who should be paying attention to these changes in particular?
So it's mainly at this stage, it's mainly about property investors, whether that's in your personal name or within the trusts. They haven't really touched the negative gearing or CGT when it comes to self-managed super funds or to companies. So they have recently made changes to SMSFs, but it's not really about these negative gearing and CGT changes.
Okay. So in terms of like the questions that your clients are bringing you or sort of their opinions and views, what do you see to be the biggest misconception since budget night?
Most people are thinking that negative gearing has basically just been abolished, which isn't the case. It's been restructured. The rules have changed. But again, those changes don't actually kick in at this stage until 1st of July 2027. So there is some time to work through these changes.
Yeah, okay, correct. Great. And we'll get into that a little bit more as well. But let's go back to the CGT changes. First of all, for those who are new to the business world or property world, could you explain a little bit what CGT is? How does it apply to property owners?
Yeah, so CGT is basically a tax on the profit. So, you've got your cost base and you've got what you've sold the property for. And so the difference is basically what is taxed.
When you say cost base, do you mean for what you purchased the property for, what it was valued at the time of purchase?
So what you purchased, well, it depends on your specific case, but most of the time it's what you've purchased it for, plus like stamp duty and those sorts of initial costs.
Okay.
So that all forms part of your cost base, and then you've got your sales. So you've got your sale price less your commissions.
Oh, okay.
And those sort of costs as well. So it's the gain. You're getting taxed on the gain. So
the difference between?
Yeah, the difference between the two. But so since 1999, I think it was, the 50% discount was introduced back then. So that means if you made, say, $200,000 profit, you would only get taxed as long as you've held it for more than 12 months.
Okay.
You'd only get taxed at $100,000, so 50% of your gain.
Half of that.
Yeah,
okay.
So that's part of what they're talking about changing.
Okay. And does capital gains tax apply to your home?
No. So your principal place of residence is always exempt.
Okay.
And they haven't tried to hit that one just
yet.
Not
yet. Not yet. Give them time. And what about superannuation? Does it CGT apply there?
Super funds do, so self-managed super funds do have CGT as well, but they have not, the government at this stage have not indicated that they're changing the goals with super funds. So you can sit tight if you've already got property there.
Okay. So could you explain to me the changes that have been or will be made now since the budget release happened? Or what are they expecting to do?
So with CGT, the 50% discount is going to be replaced with what it used to be in the older days, which is your cost-based indexed. So basically it's indexed at inflation year on year, and that kicks in from 1st of July 2027. So if you've already got a property, you've got until your 50% can still applies up until 1st of July 27, and then after that it then becomes indexed. So you can have a two-step calculation.
Could you explain a little bit to me what indexation means?
Yeah, so instead of just simply going cost base, purchase price less cost base, that's your capital gain.
Okay.
And then you get your 50% discount. It's going to be indexed to what the inflation has been over the years, so of how long you've held it for. So if inflation goes up 4% in 1 year, that'll be reflected in your capital gain calculation.
Okay, and who do you foresee to be hit the hardest in sort of these changes that are coming in? Is it someone that maybe's purchased last year or someone that's purchased 30 years ago, or does it not matter at this point?
Your long-term holders at this particular point in time are probably the ones that are going to be less affected.
Okay.
Excuse me. Long-term property owners, they would already have significant, or most likely would have significant capital gains prior to this change, 1st of July 27. So they won't be generally affected as much as someone just going into the property market right now.
And superannuation, how is the CGT changes affecting what happens in your self-managed super funds, if at all?
Yeah, so there's actually no change at the moment.
Okay.
It's actually, I believe it's exempt at this stage from the CGT changes.
Okay.
So super funds will still calculate the way they have in the past.
And which is with that discount, or is
they get a slightly different discount. It's a 1/3 discount, not a 50% discount.
Okay.
And I haven't seen anything at this stage to suggest that's being changed. So yeah, at this stage they're still exempt.
Okay.
As are companies, but companies have never had that 50% discount.
Okay, so it's only been for individuals, is it?
Individuals and trusts, although trusts will generally come down to the beneficiaries, who generally are individuals. So
right.
That's the sort of market target that the ATO or government are after.
So you've mentioned that the new rules will apply from the 1st of July 2027. So we're now in early July 2026. So
correct, yeah.
What kind of window does this allow for people who are expecting big gains? Like what kind of does that create a genuine window for people who are sitting on big gains right now?
Yeah. So look, I wouldn't suggest that people necessarily rush out and go and sell their property because of these changes. Obviously,
so I think some people are actually thinking of doing things like that from what I'm hearing.
Yeah, we've got this next 12-month period. Let's get in front of your advisors, whether it's your accountant, lawyers, real estate agents, whoever the case is, and talk about the ownership, the ownership structure that it's currently in. Is it worth moving it into a different structure? Is it worth selling?
Because there will be cost involved as well if you're moving from, for example, one structure to another. So
the one big thing that's absolutely been missed is everyone is going on about what the federal government is talking about, but then you've also got your state taxes. And as a state, your state government, are they going to forego transfer duty because of a change that the federal government's made?
Highly unlikely.
Highly unlikely, I'd suggest as well. But nothing's been spoken from that state level.
Yeah.
So you just got to wait and see what pans out.
And when you're talking structural changes, are people thinking of changing the asset or changing the structure of how they're holding those assets?
Both, to be honest.
Yeah, and does that make it, would that make any difference? And I know you're not able to give specific advice because every client is different, every asset class is different. Yeah. But Are there any benefits or disadvantages other than the cost component of it from changing from an asset held as an individual to another type of entity?
Look, that's a pretty tricky question.
I think the question for me is, why are they looking at that? What are they thinking they're going to get from it rather than
CGT is obviously a big factor.
Yeah.
And what is being reworked, as you might say, with the federal government. But negative gearing is also another factor to play a part in all of this, especially with the property. But CGT, don't forget, it's not just investment properties. It's any asset, basically. So if you're holding shares and you want to sell your parcel of shares, then that 50% is gone as well. So it's not just property. That's obviously the biggest focus, and that's what the federal government keeps talking about, but it's absolutely any asset that you sell.
That's true.
Apart from your principal place of residence. So.
And I've heard that there are changes as well, like whilst those people have held those assets for decades, rules may not apply going part, like the grandfathering rules.
Yes, that's the grandfather type rules.
Yeah.
So anything pre-budget night, they have said will be grandfathered. So
protected to some extent?
Correct, yeah. So these new rules won't apply to those, well, in this case we're talking about the properties, so they won't apply to the properties. So CGT, if it's grandfathered, then it's well, actually, no, sorry. With CGT, you still will have the change. It's with negative gearing that will stay grandfathered.
Right. Let's talk about negative gearing. So negative gearing on established residential properties purchased pre-1 July, affected or not affected?
So it's properties...
I think that's the most misunderstood, I guess, conception of the negative gearing. Let's start with what is negative gearing and how does it apply to residential property now?
Yeah, so negative gearing basically is if you've got an investment property, you've got your income that you're earning from that property less your expenses. So at this point in time, a lot of property is basically run like that. You do get some that are positively geared, which means you're essentially covering your costs of the holding that property, whereas negative gearing is you're not covering those costs.
Loss.
You're making a loss.
Right. So if you're making a loss on the property, how does that play out in your tax planning?
Yeah. So
before
budget night, if you held that property, you say you make a $10,000 loss and you're making $100,000 a year as your salary, you can then offset that $10,000 against your $100,000
from your salary.
From your salary. So you're paying tax on $90,000 rather than paying tax on $100,000.
Right.
Moving forward, though, unless it's, or depending on the property that you've got, the new approach will be that you basically capitalise that negative gearing component. So that means when you go to sell that property in the future and you've made that $10,000 loss, you won't be able to claim that on your tax each year. You'll add that into your calculation for capital gains at the end instead.
Okay. So is that what they're referring to where they say losses are quarantined and not lost?
Correct, yes.
So how do you factor that into your capital gains?
So that will come off. So your sale price, $1 million, you've made a $10,000 loss for 5 years, that's $50,000. So you'd then factor that in.
But the value of the property has increased.
Correct, yes.
So you'll still be hit with capital gains tax, but there's be some sort of
But
offset.
You'll have an offset, so to speak.
Right.
Yeah. So you reduce your sale price effectively by those losses because it's quarantined.
Okay.
Yeah.
What about people that already owned investment property before? Does that mean the rules for them now change? So they are no longer, they were able to make those offsets in their tax, but now that they're not able to, or how does that work?
Correct. So as long as you owned a property or you had a contract signed prior to budget night, the new negative gearing measures don't affect you. They don't apply to you. It's only any property after that. And it's only existing property as well. So this is where they've made a clear distinction between, used property or existing property and new builds. So if it's a new build, you can still negative gear.
Okay, so what is a new build? What falls under that new build sort of
so it's
description?
basically house and land packages, certain new apartments that meet the criteria.
Off the plan?
off the plan, yeah. So there is a set of criteria that I believe is being released.
Okay.
And
fine-tuned, I'm sure, yes.
Yeah, exactly right.
Yeah. Okay. So, we act for some developers that are selling like residential land with house and land packages with joint ventures with builders. And we did have a couple of purchasers really pushing to get those contracts signed to be pre-budget night, but it may not have made a difference because they were off the plan and they would have still been.
Yeah. I think the big objective from the government is, we're trying to create new housing supply, and that's what they're really after. So the existing pre-budget night incentives will remain for those new properties, basically.
My 2 cents worth on that. Often the off the plan purchases and these sort of new properties are more outskirts anyway.
Correct.
Yes, they're creating new developments, which was always going to be there anyway.
Yeah.
So I don't think there's going to be an upsurge of that, but allowing people to still do the negative gearing for those ones, they're not necessarily always investment types. You find, in my experience, they typically owner-occupiers out for those types of purchases, but maybe that will change as well, and there'll be some investment in infrastructure and things like that in those areas. All right, so you mentioned the cutoff was the 7:30 on budget night, so that's different from the capital gains tax trigger point?
Yeah, so capital gains kicks in 1st of July 27.
Okay. So who's been affected most in terms of these negative gearing changes? Does it apply to all types of properties, all types of owners? Like, is it, my understanding is residential, self-managed super funds?
It's people that have been buying in trusts, people buying in their personal names, and I suppose people that are buying established properties, not the new properties.
And when we're talking about properties, we're talking about residential property, commercial property?
Residential. No, so commercial actually hasn't been mentioned at all. So it appears commercial's not being touched at this stage.
All right. No, that's good. If we put CGT and negative gearing together, like the changes that have come out since budget night, what type of investors going to be feeling it the most? Is it your resi, your self-managed super fund investors? Is it your commercial property investors? Like, who's feeling it?
It's going to be people that have bought through trusts and your individuals. They're the ones that are going to be feeling all these changes.
Okay. Is there any type of investor who's actually better positioned under the new rules than the old ones?
Again, it depends. On CGT side of things, it's the investors that have held property for quite some time. They would still be in a good position going forward.
Yeah, so they're not being impacted
not as badly
much
as others at this stage.
The newer investors in residential.
Correct.
Now, I know that a lot of people might be looking at the fact that commercial property has somewhat been protected to some extent in these changes. Are you finding that some of your clients are probably looking or steering towards potentially looking at commercial property as a much more attractive solution than residential?
Yeah, true, very true. They are looking more down that path. I think with the supply and demand of commercial, though, it's going to be interesting times in that space. There are risks with both, residential or commercial. Potentially, you can get higher yields out of them. Getting someone to lease them can be difficult at times, but that's reflected in the higher yields that you get.
Yeah.
But they're not getting any of this tax reform that residential properties are getting.
So for commercial property, you can still apply that negative gearing. So as far as we know, we can still apply negative gearing concepts or strategies to commercial property investment.
Correct.
Like you did say, there are some risks involved with commercial property, as in any type of investment, whether it's share, residential, commercial. There's some benefits there as well. Like you've got, like you said, your higher yields. You've also got potentially longer term tenants.
Yep.
Tenants will pay your outgoings.
Correct.
And then on the risk side, what are the risks that you're seeing as well?
So you can have, again, just going back with, possible longer vacancy rates. There can be more complex leasing arrangements in place. Some tenants might want you to contribute an upfront amount to help them
fit out things like that.
Correct.
Yes.
So,
And it's
there
also
are the pluses and minuses.
Yeah, it's depending on the tenancies as well. So if you've got your your retail shop leasing or your commercial, and also the stability of the tenant. So you could sign a 10-year lease and then you've got a really terrible tenant that doesn't pay rent.
Yeah, exactly right. It comes back down to the individual's investment strategy, to be honest. So.
And the type of asset that they buy, not necessarily just because it's commercial, it's going to be a great investment.
Correct.
It could also be a terrible investment.
Yeah, it's no different to residential, to be honest. You buy existing, you buy brand new. You
different
might have
areas, different zones, different demographics.
So many factors to play, not just the tax side of things. So, yeah.
For someone sitting on commercial or residential investment right now, what are the most important questions? So whoever already owns residential or commercial, or looking at buying residential or commercial, what kind of questions should they be asking their accountants leading towards 1st of July?
You shouldn't assume that the changes that they're mentioning are going to affect everyone, in the same way. So obviously, you need to do some I'd say due diligence or some background into your personal circumstances. So I think a big thing is, when did you own the property? Is it going to be grandfathered? Is it not? That's a major factor. Whether a new property is going to be more attractive if you're looking at purchasing than purchasing an established property. Again, it does come back to your circumstances and where you sit with the idea of negative gearing and that sort of jazz. I guess
also, if you are buying residential property, whether it is going to be making a loss or a profit now is going to be more relevant, and whether it is going to be more beneficial to find residential property that's going to give a higher yield than one that's going to, because you won't have that benefit moving forward as well. Is there a real window here, once you've talked to your accountants about the best strategy to sell, restructure, reposition, and sometimes that may be an option for a particular client?
Definitely. So this is the period now. I think we've got a good, less than 12 months now to start looking at individual structures and come up with some possible new structures or new ideas, not necessarily have to sell. Again, not everyone's in the same boat. So it is the time to really get some understanding where you're sitting with these investments and where you should possibly go.
Some strategies that people are looking as well, and some investors don't ever intend to sell anyway. So I know I've got clients that are investors that have no intention of selling. They actually intend on holding their properties beyond the grave to pass on to the next generation as well. So I guess you're right. It does depend on what the objective is of that individual investor, if there was any reason to sell, or whether their objective is to just land bank, hold, build generational sort of wealth moving forward as well.
Right.
So it's not a sell sort of strategy.
No, definitely not. It's consider your structure and where you want to be going.
So when would be the best time for current investors and future investors to talk to their accountants or advisors about these types of things?
I would say get onto it as soon as you can.
30 June 2027?
That's probably leaving it a bit too late. I would, probably in the next few months, start the conversation if you haven't already started it. Not everything's been put through Parliament as yet, so there will still be changes. As we saw a couple of weeks ago, they changed the tune with self-managed super funds being able to borrow monies any longer. So that's certainly changed the window for self-managed super funds, so to speak, and being able to invest in property. Obviously, if the super fund's got money, then they don't need the borrowings and they can do it. So
not everybody,
no issue,
unfortunately, not everyone is positioned in that way.
That's right. So, structure, I think, is everything. The conversation is definitely the important part. So, get onto an advisor, whether it's your accountant. Have a read of the market, see what the market's doing.
But putting aside budget and changes and taxes, if I were a future property investor, someone that hasn't actually dabbed in the market yet but wanted to dabbled in the market, yet, but wanted to do so. How early on, before I start looking at property or looking at purchasing, should I be visiting my accountant about, to talk to them about tax and structure and things like that?
Yeah, definitely. So you would generally speak to a broker or your bank about finance, and it's probably about the same time as when you should start talking to your accountant about, your personal finances, your taxes, and what your objective is, because everyone's objective is different.
And I ask that, Mark, because when we're buying, when we're acting for purchases in properties, often we get contracts signed by clients in, say, their individual name.
Yes.
And then they've talked to their accountant, and then the accountant says, no, that wasn't the best strategy. And then there's a lot of rigmarole that we've got to go through to rescind a contract, enter into a new contract to make sure it's in the correct entity name. So it's probably not a good idea to talk to them after you've signed the contract. No,
and especially if you're going to, say, an auction.
Oh, my goodness, yes.
You need to have everything in play, including your finance, before you raise your hand. So,
auction, for those who are not aware, you're typically always signing a contract that's unconditional. So it's not going to be subject to finance, building and pest, due diligence or anything like that. So you shouldn't, both from your accountant and your lawyer's perspective, be heading into a auction without actually doing some preliminary work, having a look at maybe potential due diligence with your solicitor and some structural or finance talk with your accountant. All right. So
and preferably buy a house with a roof on it.
Oh, yes, we've heard that one.
A client that we know didn't realise that that's a condition of his loan.
Bought a house. What was it?
An habitable house.
Yes. So, the banks tend to not really love a house where the roof is missing. Are there situations where doing nothing is actually the best call for a client?
It always comes back to the individual's objectives and where they are with everything. So with some potential clients, doing nothing might be the right answer.
Sit on your hands.
Potentially.
Sit on your hands. All right. So and I think I already know the answer to this, Mark, but what is the one thing you would say to a property investor who has not yet spoken to their accountant about any of this?
So, definitely, like we said, before you buy, before you sell, check the structure and make sure it's all correct. You've got things all lined up, and spend half an hour with your accountant going over your personal matter.
My one-liner is set yourself up for success.
That's, perfect.
And the best way to do that is to get that pre-advice before you pull the trigger.
Correct.
Yeah. All right, let's move into, these are the rapid-fire questions, Mark. So the first thing that comes to your mind, what's the one thing property owners have misunderstood most about the budget?
Okay, so it's the headlines, right? So everyone's just reading the headlines going, CGT's gone, negative gearing's gone,
property investment's on fire.
Exactly. Let's not buy. Well, it's probably the best time to buy because everyone's waiting.
Sell.
Or sell. Yeah. So, look, the change isn't the same for everyone. It's not immediate. We've got time. We've got different things that can pan out for you. So, get on to your
maybe
advisors.
Breathe, pause, and get some advice.
Perfect.
Fantastic. One action every property investor should take before 30 June 2027.
Definitely get your personalised review of where things sit and get your strategy right going forward.
One mistake investors make when reacting to the tax changes.
I'm going to keep coming back to the headlines.
Say it again.
The headline,
drill it in.
The headlines aren't the true reflection of what is being passed as legislation. So, try and steer away from these headlines that the media love to put out there and get the facts and get your strategy in place.
One last one. Negative gearing is completely abolished, gone forever, done. True or false?
False. Not quite there yet.
Not quite. Talk to your accountant.
Talk to your accountant, yeah.
Fantastic. Look, Mark, thank you so much for being on the show. We've really enjoyed having you. I think you've clarified a little bit and probably set a lot of property investors at ease, giving us a little bit of clarity, and we really appreciate your knowledge and expertise in this area. Now, I am sure that there are going to be people out there who want to talk to you more about these changes and how it affects them individually. How can they find you?
Yeah, so as I mentioned, Purple Patch Advisory, we're in Brisbane, we're in Cannon Hill in Brisbane. We're online, purplepatchadvisory.com.au. We do offer an initial 15-minute discovery call where we can meet each other, go over some basic ideas and get to know each other.
And that can be done by call or Teams? They don't have to be in person?
Generally Teams is preferred, so you can actually talk to the other person a bit nicer.
I like Teams as well.
But phone calls just as easy. In office if you really like to.
And your clients, do they have to be, local to Brisbane, or where do your clients?
We've got clients from all over. We've got a few down in Victoria, a few up north. So no, they don't need to be local. Not with technology these days.
They don't have to come see you at the office.
No, of course not.
Though you do make good coffee.
Thank you.
Fantastic. All right. So the website again, phone number and email.
Yep, so it's purplepatchadvisory.com.au, 0731669595, or you can email myself directly, mark@purplepatchadvisory.com.au.
Fantastic. Thank you so much, Mark.
Thanks, Liz.
You've been listening to The Commercial Edge, the podcast where we dive into the real stories, strategies, and legal insights behind smart business and property decisions. I'm your host, Elizabeth Rebolledo, lawyer, founder, and fellow entrepreneur. I'm so glad you joined me today. If you've got value from this episode, make sure you follow the show so you never miss a conversation. And if you're building, buying, or growing something great, head to ardorlegal.com.au. We've got practical resources, guides, and legal support to help you move forward with confidence. Thanks again for tuning in. I'll see you in the next episode.